What if the way most people value £1 million business is the reason why they overpay? I've seen buyers, myself included, get sucked in by the numbers. Numbers that look good on paper, but with businesses that show profits that never hit their bank account. So let's dive into these 15 lessons to help you spot the dangers and buy a business with confidence. So lesson number 1. When I was searching for the business I finally bought, I found a haulage company that looked like a strong deal on paper, but the price felt high compared to its latest set of accounts. Something didn't quite add up, so I dug deeper into the numbers. I could see what the broker had done. They'd used EBITDA to value that business. And this ignores depreciation. But with haulage companies, lorry depreciation is huge, and taking it out inflates those earnings. Replacing those lorries is a real ongoing cost of staying in business. The seller wouldn't drop the price, so I walked away. But that decision stuck with me. It showed how easy it is to overpay if you use the wrong valuation method. I calculated the valuation using EBIT instead, which includes depreciation. This meant, by my reckoning, the business was worth far less than the broker's valuation. So, lesson number 1 is don't use EBITDA to value businesses, especially asset-heavy businesses like haulage, manufacturing, or engineering companies. Legendary investor Warren Buffett warned against EBITDA. EBITDA hides the true cost of running a business. He famously said, "Does management think the tooth fairy pays for capital expenditures?" EBITDA makes profit look higher than they really are, and you'll value the business above what it's worth. Use adjusted EBIT to value a business instead, so depreciation is included in your calculations. If you ignore the cost of replacing the assets that keep the business running, you'll pay too much for the business. You'll be the one who will pay for it down the line. Lesson number 2. During my search for the £1 million business I bought, I found a food wholesale business. But the price felt high when I compared it to the latest accounts. But here's the thing. Back then, I wasn't confident enough to fully trust my valuation. The broker and the seller kept talking about future potential. And because I was new to the acquisition world, I wondered if it was me who had it wrong. So I dug deeper into the accounts and compared the figures to the valuation. But I kept circling back to the same feeling. The numbers still didn't justify the price. That frustration pushed me to build the first version of AquaCalc, which is my business valuation tool. This Excel tool turns accounts into clear, comparable, adjusted earnings. And this meant I could quickly value every business I looked at using consistent rules. And here's the thing, I'm a chartered accountant. Even I couldn't see the real value in a business by looking at a set of accounts. I still needed a tool to reveal the hidden value behind the numbers. This meant I could be confident in my valuation, as the software is designed to use the historic numbers from the business itself. I could then push back on any valuation that was based on a promised future, which is difficult to verify. So, lesson number 2 is to make sure you value businesses based upon historic performance, not on future dreams. You should only pay for what the business has already done, not what someone else hopes it might do. And remember, brokers sell the dream, not reality. Brokers often inflate expectations because it's what wins listings. But don't be misled, and you may be better off finding off-market deals instead, because here's the problem. Once a seller believes that dream, bringing them back to reality is a real challenge. It will likely take time that you'll never get back. When the numbers don't align with the price, and if the seller is sticking to what is an unrealistic price, walk away with confidence, but always leave with a price on the table, which in lesson 14 you'll discover works. Every hour spent fighting unrealistic valuation expectations is an hour spent not finding a seller who needs to sell, but who will be realistic with the valuation because they are motivated to sell. Your confidence will take a major boost when you get your first seller to agree with your valuation. Lesson number 3. When students first come to me, most don't truly understand a set of accounts. And those who do understand often don't know how to interpret them to confidently value a business. They see sales, they see profits, and perhaps margins, but they can't yet see what those numbers really say about the value of a business they want to buy. I watch the same thing again and again. They get stuck at the first hurdle. They don't know where to begin. So I slow everything down and walk them through the accounts, whilst at the same time entering the numbers into AquaCalc, line by line, starting at sales, then cost of sales, then overheads and any other income, showing how each step shapes the profit of the business. Then we work through the add backs and the deductions together, so they can see the adjusted earnings used to apply a profit multiple to value a business. That's normally the point at which valuation stops being theory and becomes something they can confidently calculate themselves. I always pause at the moment their expression changes, because that's when they stop looking at the accounts and start seeing the business behind the numbers. They don't know it yet, but this is the step that changes how they value every deal that follows. So, lesson number 3 is before you attempt to value any business, you must understand the business financials. This includes the profit and loss and the balance sheet, because that's where the truth of the business lives. If you don't understand the financial statements, you're in danger of accepting someone else's opinion on valuation. But once you do understand them, you take back control. So unrealistic prices don't sway you, and inflated add-backs no longer fool you. And confidence comes from your interpretation of the numbers and not from someone else's sales pitch. Know the accounts first and the valuation follows. Lesson number 4. When I walk through a set of accounts with students, they can follow the figures, but they can't yet see what those numbers are really saying about the business they want to buy. They begin by not knowing what to focus on, but by the end, they realize the business valuation comes from what the business has done across multiple years, not just the most recent one. And I see the light bulb moments and witness comments like, "This is pure learning, absolutely priceless." So we take those same figures and enter them into AquaCalc year by year. We compare margins, ratios and variances, and they begin to see how the business is truly performing over time, not just how it's looked last year. And as I already mentioned, even as a chartered accountant, I still rely on the software to interpret the numbers properly. Valuing a business means analysing multiple years at once. You can't realistically do that confidently by flicking through accounts page by page. And the moment they see how fast the valuation comes together, how quickly the trends appear, how the add-backs change real earnings, that's when everything clicks. Their lack of original confidence immediately changes to valuing a business with clarity and confidence. They finally understand the financial reality behind the business, and that's because they can finally see the story in the numbers. So, lesson number 4 is that software like AcquiCalc will speed up the process. It will show you how the numbers affect the value, and it will give you the confidence you need to value a business. To value a business properly, you must look across multiple years, ideally a minimum of 3 years, but up to 5 years. You should always analyze trends, ratios, and variances too. When you use software like AcquiCalc, you'll be able to understand how adjustments change the profits used to value a business, but ultimately the business's valuation. Lesson number 5. A client once came to me who was stuck on what felt like a small detail. Should stock or inventory be included in the price or added on top? But here's the truth. That depends. When it's a share acquisition, the valuation should normally already include stock. But with an asset purchase, stock is included as one of the assets, as part of the total price. And to make things more confusing, brokers often quote a price as X pounds plus stock at valuation, or SAV, even if it's a share purchase, which could lead to an ill-informed buyer paying too much for the business, especially when a business holds significant stock. So I walked him through the logic. For a share purchase where the business is valued on a profit multiple, the valuation already assumes the business has the right level of stock required to produce the profits that are used in the valuation calculation. Or in other words, stock sits inside normal working capital, where working capital is included in what you buy with a business that is a going concern. It would be like buying a manufacturing business without the machinery. Once he saw that, the penny dropped. The price of the shares reflects the business as it stands, not an empty shell. The doubt that had been holding him back disappeared instantly. He could finally move negotiations forward with confidence. Sometimes one clear answer unlocks the whole process. So, lesson number 5 is when you buy a business as a share purchase where the value is calculated using a profit multiple known as enterprise value, stock is already priced into the valuation. Enterprise value should already include the assets required to run the business, which is the same assets the business needs to produce the profits used in the valuation calculation. If stock is added on top, you'd be paying twice. But if it's an asset sale, the rules change, where stock forms part of the total price paid. Have you ever bought shares on the stock market? If you have, you'll realize you don't pay again for stock. The price you pay for the shares already includes it. Learning this now avoids any confusion in the future. But importantly, it will avoid you overpaying for the business you buy. Lesson number 6. On my journey to buy the business that I bought, when I met business owners face to face, I needed to know whether the business could run without them. But by asking this directly could make sellers very defensive. So I needed a way to uncover the owner dependency. If the business is heavily reliant on the owner, it's like owning a job you can't get away from. What value are you really buying once they leave? So I began asking questions about their holidays. usually as part of the getting to know each other phase of the process. This way it feels more about them rather than about the business. If they hesitated, they couldn't remember their last holiday, or if they laughed it off, I already knew what that really meant. The business probably couldn't function without them. Those questions reveal more than any spreadsheet ever could. If they couldn't step away from a business for a week, how could I ever step into it as a new owner without everything just falling apart? It saved me from deals where I could have bought myself a job and not a valuable asset. So, lesson number 6 is if a business cannot operate without the owner, the business's value will be extremely low. But a business that is heavily reliant on its owner isn't worth buying at all. This is unless it's a bolt-on business to one you already own. A business you own that already has employees who could take over from the exiting owner. Because you're not really buying a business, you're buying yourself a job. Understanding how much the business relies on the owner tells you whether you're buying an asset or just someone else's headache. If they can't take a holiday without everything stopping, you won't be able to either. You may pay more for a business that already has the right employees in place, but at least you're buying yourself a valuable asset. Lesson number 7. After I bought my business, I joined an alternative board. This is where members share their challenges openly. One member ran a business where 80 to 90% of revenue came from one single client. I didn't realize it yet, but I was about to witness what an overdependence on one single customer meant in real life. And then it happened. They lost that client, and almost overnight, the revenue disappeared. And without that single customer, the business could not survive. I didn't just see the risk, I felt it because I watched someone lose a business, one they'd spent years building. I watched them lose their income, their home, and their dignity. I will never look at customer lists the same way again. So lesson number 7 is when one or a few customers make up most of the company's revenue, the business will be very fragile. In this case, the valuation must reflect that risk. If you are even considering an acquisition like this, I suggest you don't. Because if you do, you risk losing the entire business if one or two of those large customers leave after you've bought it. This risk is called customer concentration risk. This risk doesn't show up in the profit, it shows up only when the customer or customers leave the business. But when they do, the whole business can collapse, like a pack of cards. Before you value any business, look at how the revenue is spread. The broader the base, the lower the risk, and the higher the value. The narrower the client base, the higher the risk, and the lower the valuation should be. A deal can look good on paper, that is until one customer walks away. Lesson number 8. Before I committed to buy my £1 million business, I needed to know where customer loyalty lived. Was it with the brand or with the owner personality? Because if loyalty sits with the owner, once they leave, there's a high risk clients will leave at the same time. So during due diligence, I looked closely at how customers interacted with the business. The business I bought had over 1,000 customers. There was an average spend of between £1,000 to £2,000 per customer. And most interactions were with the employees of the business, not with the owner. I checked the reviews too. These spoke about the brand and the work of the business, not about the person behind it. The more I looked, the clearer it became. Customers were buying the brand. Many didn't even know who the owner was. That told me something that no balance sheet ever could. The value would stay in the business after the owner stepped away, and that gave me confidence to buy and to value it with conviction. So, lesson number 8 is if customers buy the brand and not the owner, the value of the business is transferable and the business will be worth much more, as the earnings you're buying are more likely to continue after the handover. And here's the thing, any valuation assumes the future will look similar to the past. If the customers are loyal to the owner, the value of the business will be much lower. And I suggest you don't buy the business at all, unless the deal is contingent on it retaining its current customer base. Otherwise, you need the business to have customers who are loyal to the brand and not loyal to the person who's exiting. When loyalty is with the brand, the price will make more sense, so you can buy with confidence. Lesson number 9. When I found the business I eventually bought, I knew nothing about the industry. But I didn't want to buy a business that would grind to a halt the moment the owner stepped away. Before I could commit to buying it, I needed to know whether it could run without me. So I looked past the accounts and into the people who kept the operation moving. There were 27 employees already in the business, but crucially, the business already had a management structure in place, a production manager, a factory foreman, and a lead designer. These were employees who understood the business when I bought it. Production didn't just suddenly stop. Customers didn't really notice, and the work carried on. That's when I realized the right people make the handover possible and make the business valuable and viable. So, lesson number 9 is if the right management team is already in place, the business will be worth much more. You're not just buying what you know, you're buying what they know. The business's value is in the team you buy. And here's the thing, strong managers are what make a business less dependent on the seller. The value stays with the business when you buy it, rather than walking out the door with the owner. And that's why a solid management structure makes a business more valuable, because the profits you're paying for are more likely to continue after the handover. With capable managers running the day-to-day, you don't need to be the expert from day one. The team already is. If the management team is strong, you can buy any business because the business runs with or without you. Lesson number 10. When I was assessing a potential acquisition for a client, which in this case was a wholesale tire business, on the surface, the business looked strong. It had high turnover and plenty of orders. But although the sales are high, the profit wasn't. So I dug into the accounts and broke the numbers down properly. This business was running on a 10 to 15% gross profit margin, which meant the only way to make meaningful profit was to force turnover through the roof. I walked my client through the reality. At these margins, everyone will be working flat out just to stand still. Once the margins were clear, the decision was to. My client didn't buy. Not because the business lacked activity, but because that activity couldn't translate into sustainable profits. They realized sales volume without a decent margin isn't value. It's a business that will be difficult to make it profitable without burning out its employees. So, lesson number 10 is buying a business with very low gross profit margins doesn't have a value as the risks outweigh the reward. For a business to have value, it should have gross profit margins of 40% or higher for it to consistently make meaningful profits and to be a business that's less risky in a downturn. Check the margins early. If they're low, walk away from the deal. Lesson number 11. When I was searching for the business I bought, I needed more than strong numbers. I needed confidence those numbers would keep going once I owned it. I was looking for a business I could trust, a business that had already proved it could survive the ups and downs that every business faces before I could believe in the valuation. I needed to believe in the longevity. So I ended up focusing on a business that had nearly 30 years of trading behind it. A business that had not only grown to 1.6 million in sales, but it also survived 2 recessions along the way. That history gave me what no spreadsheet ever could. Its track record wasn't written in a pitch deck, it was written in time. A company that's already weathered the storm is far more likely to stay afloat than one that's only been around for less than 5 to 10 years. That gave me conviction to buy. So, lesson number 11 is to look for a business that has a long trading history. Ideally, one that's traded for more than 10 years. This will give you your valuation something solid to stand on. A business that has survived multiple economic cycles is more likely to keep earning at the level you're paying for it. This makes the valuation more reliable and the purchase far less risky. When you buy a business, you're buying the expectation that profits will continue because track record builds confidence and confidence is part of the business's value. Lesson number 12. When I was searching for the business I bought, I found a cleaning company that looked promising on the surface. But once I began due diligence, the truth showed up in the numbers. They hadn't paid their PAYE or VAT for several months, which was a cash flow distress signal. This was a massive red flag. I had originally agreed to buy the business using seller financing, but unpaid taxes told me a number of things, one of which, as cash wasn't coming in fast enough to cover its existing commitments, how could it ever pay the seller financing payments too? The business was on the market for £450,000, but based on the debts and the instability, I revised my offer to £50,000. This reflected the additional risk and reflected the unpaid liabilities. The seller refused, so I walked away. I couldn't ignore what the numbers were telling me. £50,000, I could afford this risk, but anything more meant the risk was too high for me. Walking away became the easiest decision because if the business couldn't afford to pay its taxes, it wouldn't be able to pay the seller finance or me. So, lesson number 12 is that profit means nothing if the business can't pay its bills. And if a business has cash flow difficulties, this should be reflected in its value. But if this is your first business acquisition, I urge you to not even consider a business that's in financial distress. Buy stability, not uncertainty. Instability puts your valuation, your financing, and your future earnings at risk. When you value a business, you assume profits turn into cash. But if cash flow is weak, profits become numbers on paper, not money in the bank. Lesson number 13. When I was searching for the £1 million business I bought, I found two that looked interesting at first sight. They were a fireworks business and an ice cream business, but both came with the same question. Can the business make money all year, or only when the season turns up? With the fireworks business, I asked for the accounts, but when I stepped back and thought about seasonality, I could see the problem clearly. One short burst of sales and a long stretch of much lower revenues. I ruled the fireworks business out quickly. I needed a business that paid its way every single month. With the ice cream business, I went a bit further. It had ice cream vans and supplied restaurants, but the business was making losses. I visited and met the owner, and I tried to see a way forward. But I couldn't find a path to profit that didn't depend upon better weather, deeper pockets, or both. In the end, I walked away from the deal. I couldn't afford a first deal that needed rescuing, and one that only made money for part of the year. I didn't want to spend months waiting for revenue, whilst funding losses and fixing problems I didn't fully control. So, lesson number 13 is that seasonality reduces value and losses multiply risk, especially on your first deal. A business can look profitable over 12 months, but the underlying figures often show that most profit comes from just a few short months. So, valuation should reflect that volatility. If you buy a seasonal business in the low season, you'll need cash to cover the losses until the higher revenue returns. But this should be reflected in your valuation too. But I recommend you buy a business where cash flow works every single month, not one that only works when the weather, the timing, or the season is right. And whilst loss-making businesses can be turned around, that only works if you know how to fix the problem, you can fund the turnaround, and you can handle the hassle. For your first deal, you need cash flow from day one, not a rescue mission that drains your money. Lesson number 14. I found a kitchen business to bolt on to my fitted furniture business I'd already bought. Strategically, it made sense. On paper, it looked like the perfect add-on. But when I valued it based on what it was worth to me, my number came out at £50,000. The seller wanted £200,000. I put forward my £50,000 offer with confidence, but the seller rejected it immediately. I didn't raise my offer, I didn't chase, and I didn't argue. I carried on looking for other opportunities. It made no sense to pay more than my valuation. Plus, I didn't need the deal. But here's the thing. Months later, the seller came back to me. He finally accepted my £50,000 offer. Nothing about the business had changed. It was his expectations that had changed. And that was the moment the number stopped being my price and became the price we could both live with. So, lesson number 14 is that any valuation is just a number until a willing buyer and a willing seller meet at that price. If the gap can't be closed, there's no deal. You need to be confident in your valuation, especially when it's based on the accounts of the business. If the seller won't budge and you can't justify moving either, don't chase. If your valuation is fair, leave it on the table and let time do the talking. But before you begin any negotiation to buy a business, I always recommend my students read Never Split the Difference by Voss. It's full of powerful negotiation techniques that will help you confidently close the gap on price. There's a link in the description below. Lesson number 15. When I first started searching for a business to buy, I focused on smaller businesses I thought I could afford. These were businesses that couldn't immediately replace my current level of earning. But I hadn't realized it yet. It's the business that needs to afford the purchase to effectively buy itself, not me. And then I had a light bulb moment because I'd sold my last business using seller financing. Why couldn't I buy a business in the same way? Once that had clicked, I stopped looking at smaller businesses. I started to look at £1 million businesses instead. I realized it takes roughly the same effort to buy any business regardless of size. But £1 million business with profits of at least £100,000 makes it all worthwhile. I found several deals along the way that agreed to seller financing. One I've already mentioned, the one that had serious cash flow problems, and the other one where I took too long to arrange the other financing, which was in addition to the seller financing the owner had agreed to. This meant I lost the deal and learned a valuable lesson. Once you've agreed a deal, work very quickly, especially if it was a deal like this business, which was very profitable and a fantastic business. Having said that, the business I eventually bought had sales of around £1.6 million. The deal was part funded by seller financing, part bank financed, with the balance coming from my other business. By going bigger, it made it far easier to buy a business I knew nothing about, which in my case was a fitted furniture business. It was made easier because it had those 27 employees. It also had that management structure in place to run the day-to-day. That meant I didn't need to be the expert on day one. The business didn't even miss a seller. I was able to step in almost seamlessly. So lesson number 15 is if you want your valuation to make financial sense, focus on £1 million businesses only. Businesses that are big enough to replace your salary and that can run without you. The thing is, smaller businesses are cheaper for a reason. They won't have profits high enough to replace your current 5 to 6 figure salary. Plus, most businesses with sales of less than £1 million are more likely to be heavily dependent on the owner. That means you'd be buying yourself a job, not an asset. Here's the truth. A business with £1 million turnover is a milestone most businesses never hit. This is why £1 million businesses carry more value, and why I only recommend you buy a profitable, cash-flowing £1 million business in the first place. Although all of these lessons that I have just taught you are incredibly powerful, if you don't yet know the type of business you want to buy, then none of them are going to work. So watch this next video where I'll show you how to decide on the type of business you want to buy so you can get the result you're looking for.